Real Estate Jam session. Today we're going to talk about single tenant net leased investments and the different types of them. I've got George Pino, CEO of Commercial Brokers International, on for the show today. George has done deals in 30, are you at 34 states now?
36.
36 states now. So he knows a little bit about SDNLs, and so I think he's going to be a great resource for you guys. George, thank you for coming on the show today.
Thank you for having me.
Now you can see in the background here, I'm in Dallas, and it's going to be a little bit wet and cold here. So I hope you're enjoying that Southern California weather.
Yeah, you know, it's we're nowhere near as wet or cold, but it's not exactly the sunniest of days in Southern California either. So.
All right. Well, good. That makes me feel a little better. All right. The different types of SDNLs. I think, you know, we really, when we hear SDNL, we think fast food, right? And I want to make sure that there's a complete understanding that there's so many different types of SDNLs. Can you, first of all, I guess, let's walk through the different types.
Absolutely. And first, I also want to do a very quick explanation that, you know, a lot of times people will call an SDNL a triple net lease. But realistically speaking, you can have, you know, a SDNL stands for single tenant net lease. A triple net lease, they could still be part of a center or in another retail building or even some office buildings. So, you know, SDNLs are single tenant net leases. And they're, you know, essentially different types. As you mentioned, the most common is probably your QSRs, which are fast foods. And then you also have like the FSRs, which are your more fast casuals, kind of like the Applebee's of the world and the Chili's. In addition to that, for the smaller size, and we're going to go from small to large, but you know, in the medium size, you have gas stations with convenience stores. You have everything from the learning center type of operations. You also have medical buildings, medical office buildings, or medical treatment centers that could either be part of, you know, like for dialysis for Fresenius or DaVita. And then in addition to that, there's other medical type uses as well that, you know, MRI centers that can go in, or surgery centers, or even urgent care. So those are all considered SDNLs if it's a single tenant in that building. From there, you start going into what we call, you know, some of the big box SDNLs. And that can be things such as your, you know, the larger Crate and Barrels, Best Buys, grocery stores, Walmarts, drug stores, even like the Walgreens and CVS's of the world. And then from there, lastly, you now have industrial as well. So a lot of industrial is typically not considered as an SDNL market, but there are many times you can have a tenant that is very well rated on, you know, S&P rated, corporate guaranteed, very strong tenants that occupy the entire building as well. So that would still fit the definition of a single tenant net lease as long as the lease was net.
Right.
So you see that a lot, especially, you know, right now with, you know, hot topic these days are distribution centers. So you see that a lot with some of the distribution centers, whether it's FedEx or Federal Express, or even, you know, the post office or UPS. UPS owns a lot of their land, so, you know, you normally don't see those up for sale very often, but every now and then. But
well,
you know,
Walmart and Amazon are leasing.
I was just going to go into that. Even going into there, you have, you know, and that's just kind of the FedEx is one aspect of it, but you start looking at Walmart, Amazon, all the major retailers that are large that need that distribution center or area. So they, and the nice part about the distribution centers, the way they typically work is you have a large regional center, which everything goes into, but then it is also dispersed out to smaller distribution centers that are more in the inner city areas. So it cuts down on drive time. It allows them to deliver within a day or same day delivery, things like that. So, you know, you have the capability of acquiring properties in the $1 million range up to $20-30 million. In some cases, 80.
Well,
more.
You get into those big ones. Aren't those mostly going to institutional investors? The Walmarts, the Amazons, hundreds of thousands of square feet.
A lot of them Yeah, a lot of the larger ones, and it's probably more of a price point issue versus the larger guarantees or who they um, are going to a lot of the institutional. A lot of times, also you see a lot of bulk purchases being done by institutional REITs or institutional buyers that are purchasing in bulk. 20, 30 assets at a time. Maybe it's 20 or 30, QSRs or Walgreens, and then they turn around, they restructure the leases, and then put them back on the market a lot of times. So
Yeah.
you see that happen quite a bit. But main reason for that is, you have institutional clients that they have to place a certain amount of equity, and it's just as easy
Sure.
to place $20 million of equity as it is to place 2 million. So they'd rather do it one time
I, w-
versus 10
I
times.
wished I knew. Be a good problem to have. I know that you've done
Yeah.
a lot of deals over the last couple of years for these STNLs. What do your clients like the most about an STNL investment? What is their attraction to it?
Typically, it's the ease of the management. It allows them to be able to acquire property that fulfills their investment criteria and goals. It's relatively passive income, and at the same time, because of that, it allows them to invest and expand their geographic area. So they're no longer limited to, within an hour drive of where they live to
Right.
check out the property, because the tenant has to maintain the property, they have to repair the property. More importantly, most STNLs, especially if it's a retail base, such as any of the big box companies that we talked about, or any of the retailers or fast food items that we talked about, they are very much co-aligned with maintaining that property appearance and making it look as sharp as possible and as neat as possible, because they realize that attracts customers in. So because they're co-aligned with the landlord to maintain the property, it allows for a lot less hands-on management.
Right. Don't you think also, I mean, if you do these, what's the average lease of an STNL? 15 years, 20 years?
Average, I'd say about 15 years, depending on the tenant. Some tenants, each tenant has their own lease structure that they like and that they've modified on various times. Back in the day, Jack in the Box of all things had 18 years base rent lease structure, while most of the fast food places were 20 years. Generally speaking, most fast food is 20 years, but then some are 15, and then you have people like or companies like Starbucks that have a 10-year base term, but 4 or 5 year options. Best Buys, the bigger box properties and such, they tend to be typically about a 15-year term or so.
Okay. Now, one thing, don't you think your investors like those bumps? I mean, how often do you have bumps in your lease? Every year?
Well, rarely every year, actually. Generally speaking, and generally speaking, you do see rental increases on average once every 5 years. That's typical, and it can range anywhere from. I mean, we've been seeing really low numbers now because of CPI for the last few years. We anticipate that with newer leases, with the fact that interest rates are going up, but also that inflation is going up, and therefore the CPI is going to go up. We're going to start seeing a little bit different model. Back in the day, they used to be 15% increases every 5 years. It went to 10% increases. Now we're in the last couple of years, we saw 7.5% to 8%, and in some cases 5% rent increases every 5 years. So because of that, and that was mainly because CPI was pretty stagnant for many of these areas.
Right.
So as we're seeing that change now, we anticipate that that will affect some of the lease structures for new construction.
Right. Yeah, I could just see where you can project your income out for the next 15 years and kind of have an idea where it's coming. It'd be pretty attractive. But I can also see
absolutely.
Yeah, well, I can also see
absolutely. But, I'm sorry about that.
Well, I can see the kind of the downside. What if the CPI? What if you could have raised rents more? I mean, there is a downside of it too, I guess, right? You could have raised rents more, maybe, but
absolutely. Well, here's the way I like to explain it to most of my clients as well. In that, it's always about risk versus reward.
Mhm.
So because the STNLs and triple net STNL specifically, uh, because they are considered as one of the least risky of real estate investments, you also have to understand that your returns are going to be less. So if you want much higher returns, you're going to have to take on a lot more risk. That being said, interesting article out, I think today actually, showing that STNLs have had some amazing yields for real estate overall. So even though the increases are not necessarily set, you typically don't have the fluctuations either for at least 15, 20 years. And because of that, you also tend to have, uh, if you're in an area where you're only getting 10% rent, if you're getting 10% rent increases every 5 years, but the CPI is maybe 3 a year and it should be higher, there's a much higher likelihood then that they're going to renew the lease and you're going to have less vacancies, less issues with retenanting or cost to retenant the property. So overall, in the big scheme of thing, it actually outweighs the the potential to raise rents. At the same time, in the last year and a half, we saw a lot of rents go down, not on the STNL side, but across the board for office, and not just office, but
Right.
retail and even on apartments when it comes to the COVID issues. So you have a lot of stuff that's out there, but also, I think one of the main benefits of STNLs is that it takes a lot of the liability off the hands of the owner and the landlord and places it back on the tenant. Meaning, certain states have become very uh, regulated when it comes to real estate investments, and they tend to put a lot more pressures on investors or properties, commercial properties, I should say, for the taxes and whatnot, when it comes overall in general. But the nice part about single tenant net lease is that even if a law comes into effect that says that we're gonna, like, for instance, in California we have Prop 13, but they were talking about a split tax roll for property taxes with commercial being reassessed every year. And everybody was really worried about it, but at the same time, most any rental or any tax increase is actually bared and borne by the tenant. So it takes that liability out. So you're actually looking at, here's a stabilized cash flow stream that I can expect that's going to be my net operating income versus, I own an apartment building and all of a sudden I have to replace a roof and I cut into half of my annual
Yeah, unless you
net
have the
profit.
reserves. Yeah.
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 So I think
You know,
overall it's definitely a good opportunity. It's a matter of a little bit more hands off.
right. Well, I like it for a couple things. One, it's pretty liquid, right? It's probably one of the most liquid real estate investments you can make or have. And and then also the security of it. You get a corporate guarantee or a strong franchisee guarantee, it's pretty tough to beat. And I don't think there's much
Yes,
else out there that can compete with that. What are what are the disadvantages? There's got to be a disadvantage. What's a disadvantage that you can think of?
absolutely. Well, disadvantages. Some of them could be that number one is primarily you may not necessarily keep up with the inflationary rates for some of the years. Number one, when it comes to the rent increases. Number two, though, although it's a very liquid real estate when it comes to selling it, the big negative can be the time frame it takes to re-tenant it, especially when you compare that to like a multifamily property, where if you have a vacancy, it is you could typically lease it back up within 1 to 2 months.
Right.
It can take upwards of a year and a half to re-tenant a single tenant net lease asset. You have to find the right tenant. They have to build it out, have to reposition that building and to fit their needs, and then go in. And all that is relatively expensive, but you don't have to do it every year. That's the trade-off. Meaning, the average apartment dweller in the United States, outside of California, they move about 70% of them move almost annually in apartments.
Right.
And so that means that outside of Southern California, when you're having such a high moving rate, you have lots of make ready costs, you have lots of vacancy costs. And think of it this way: even though if you have one tenant in one building, one space, 1 month equates to about 8.33% vacancy rate. So, but it so you're seeing that in if you look at it as 70% of the people in an apartment move, your true vacancy rate's at least 5%, if not a little bit higher. And that's just for people that have moved out, not necessarily what's currently vacant or having issues with. So
Okay.
that's the
Yeah.
nice part.
Yeah, I love the STNLs. I think if you're a beginner, especially, it's you want to have that base to start investing from. I think it's a great place to start from. Or if you're, a little bit older and you just want some good, you're focused on wealth preservation, it's another great way. So are
Yeah.
most of your clients that are buying triple net, what does that client profile look like?
Well,
All across the
all
board?
across the board.
Is it? Okay.
All across the board. I have younger investors that are just starting off, learning the market, where we try and help them and teach them what to look for, how to look for it. We have other investors who that's what they do, single tenant net lease. That's, they own quite a few assets. Some own, 40, 50 single tenant net lease assets throughout the country. And then you have others that are older, that are tired of the management intensive for especially multifamily, and in some cases offices as well. So they are selling those and exchanging into triple net because they're looking at a little bit more passive, wanting to really enjoy what they built, but being able to take the time off and not have to overlook the
Sure.
property or the books on a daily basis. So, this allows someone that's maybe older to get a lot more passive income, because we can also they generally trade at a higher cap rate than most multifamily in the area. So you're getting higher income, but at the same time, less management intensive, less risk. And because of that, it allows for the people to actually enjoy their life and what they built. So you see a lot that are a little bit older, in their 60s, 70s, planning more for retirement. And then you also have some that are opportunistic. I have clients that are looking for their developers, essentially AC rehab or acquisition rehab, that are looking for properties that they can reposition with other tenants that have strong locations, and you can sometimes double the value of the property in 2 years.
Yeah. Yeah. It's a good way to do it. Now I know California, what are your cap rates for triple net deal or STNL deals in California right now? 3, 4?
Generally speaking, we are seeing, for the most part, unless they are kind of the what I want to say, and the belle of the ball tenants. Those would be kind of like the McDonald's. These are your legacy tenants, legacy brands that are really large, that have strong corporate guarantees. And those are trading, depending on the submarket in Southern California, in the 3.5 cap rate range. These are whether it's your In-N-Outs, Chick-fil-A's, your McDonald's, Starbucks even. And then as you go out to some of the secondary markets, and not tertiary, but just some secondary markets, then you're seeing them probably more in the 4.25 cap rate range. Now, across the nation, and this doesn't hold necessarily true for every state, but on average, you're looking about a 50 to 75% basis point jump in the cap rate when you go out of state for the same tenant, same lease structure.
Okay. What state are you doing the most deals in?
Most of my clients, for various reasons, and primarily tax reasons, are going for a lot of the tax-free states. So you have 9 income tax-free states. But generally speaking, the majority of the properties for those, we've been selling primarily, the hot markets have been Texas, Tennessee, and Florida.
Okay. Yeah, that makes sense. Well, George, thank you very much for all this information. I think the subscribers are going to love this. There's a lot of great data. Keep up the good work out there. Let's get you to 40 states soon. And I'm going to
My
get
goal is to fill in the entire map. I'm working on Alaska right now, so
a lot.
fingers crossed.
So you've done Wyoming, Nebraska already. Well, probably not.
No.
Wyoming you have.
No.
Yeah, I think you did. Didn't
Wyoming
you?
I have.
Yeah.
Wyoming I have. But Nebraska and like North Dakota, South Dakota, it's not so much that people don't want to go there. It's just a matter of those states are less dense.
Right.
So you have less single tenant net lease type properties that have great locations.
Right. Yeah. Well, for those of you who are watching, thank you for tuning in today. If you haven't done so, make sure you subscribe, give us a like. And if you want to talk to George about triple net investments, I'm going to put his contact information down below, or reach out to me and I'll put you in direct contact. George, thank you again for coming on, and I'll get you back on here very soon.
Well, thank you. And have a safe travels back.
Thank you.